Welcome. There's an opportunity now to take a look at some of the charts and how to trade them. And one of the big themes that we've got underway at the moment has been the third quarter earnings season. And so far as US stocks are concerned, a lot of them have been crying out in pain because of the rise in the dollar. And of course, this week we've seen the Federal Reserve come through with another 75 basis points added to the federal funds rate. And this is causing issues as well for consumers. It's causing issues for a lot of aspects of the economy. But it's just a question of trying to fight inflation. Let's take a look now at all this in terms of some of the charts with one of our regular guests here on IGTV. It's Serge Berger from thesteadytrader.com. Serge, welcome. Let's pick up on this point about the dollar if we can, because it is causing problems for corporate America. The strength of the dollar, it means when you're exporting, it's more difficult to find markets because your goods are more expensive. And then when you do get the sales in, of course, when you repatriate those overseas currencies back into a strong dollar, it's causing all sorts of problems as well on the profit and loss account. Let's take a look at this in the context as well of what the Fed's doing, because we've got this rise in the dollar, which is easily explained away by the fact the Federal Reserve has been ultra hawkish. What are your thoughts as a trader around a chart for the dollar, whatever way you want to trade it?
Sure. Hey, Jeremy. Look, I think one of the things to maybe put into perspective is, from a U.S. perspective, if we had a weak dollar, this whole situation would be a lot worse from an inflation perspective. But I think the dollar's run a long way, and as we were discussing quickly before, off camera, the risk here of economic data coming in a lot weaker is quite high, and I think we're at risk here of whether it's a lower inflation print or just some other data point that people aren't even watching that much coming in very, very weak. Like I remember about a decade ago or something that we had an Empire State Manufacturing report, which is, people look at it, but it's not like the only thing. And it was so weak that it just almost crashed the whole market. It was maybe 15 years ago, 20 years ago at this point. So I think the risk there is if one is long dollar here, is that we get some data point and the dollar on that would reverse to the downside quite severely. If we look at, I brought up, for example, dollar sterling. Now this is in the atypical way of quoting it. I actually went, how many sterling it costs per dollar, as opposed to the sterling dollar curse. And basically what you can see is it's making low. So the dollar versus sterling, the pound, is making lower highs. It's also true for the euro versus the dollar. So again, this is not the inverse quotation. So the dollar getting weaker versus the euro. You can also see it if you look at yen marginally, and we talked about this last time. We're not quite there yet. It's astonishing how long it's taken, but at some point when it does break, it's going to break pretty quickly. So I think the risk here of being long dollar and hoping for some sort of a breakout, if we look at the dollar index, which is basically comprised of those three cross rates we just looked at, I think even though it certainly could happen, I think the risk to me just isn't, it's not worth taking the risk right now, given where we are.
Okay, so you're watching for a catalyst to go short rather than take this any further up. What do you do? We've got to look at the other supporting factors here, including bond yields. Sure. What do you see as happening there, which could help to give us a steer on dollar direction?
Yeah, I think in bond yields, we continue to have a very inverted yield curve. I can try to bring that one up quickly if you guys can see this on the chart. I don't know if this pulls up, but the inverted yield curve is essentially, this is the dollar yield curve. It's the orange line on top versus what the yield curve looked like on December 31st, 2022. So at the end of last year, you can see we had a very normal yield curve, upward sloping. Now we're looking at 45, 50 basis points of inversion between 2s, 10s within that area. So the bond market is clearly telling us that the economy is going to slow, and the more that the bond market, the closer we get to that, the more we're going to also see bond yields back off, meaning coming down, and then the dollar is going to come down. So watching the dollar here is probably the most important thing, to be honest with you, for all this. The problem we have right now is that the Fed remains so unbelievably hawkish, and this is all by design, right? They're thinking they can tighten conditions by just talking a tough game, which has worked in the past. But as soon as they ease off just a touch, you're going to start to see 10-year bond yields come off, and then I think the dollar is not far. But in fact, the dollar will probably lead this whole move. So again, I think the risk here of the dollar reversing lower is probably higher than people think. So I would not want to try to get caught in that.
Absolutely. So let's put this one then on the back burner as something to watch, and doubtless we'll talk about it in 4 weeks' time when we get together at the beginning of December. Because I think then you're right. We'll see some more clarity, I guess, as we see some of the economic data come through. How is all this working itself out on the S&P 500? This is we quite often look at because it's a broad base. It's got a bit more tech than it used to have in years gone by. Of course, as us who've been around the markets a while remember the S&P as a bit more sort of leaning towards old tech. But now we've got these new tech companies in there. A couple of stocks I know I want to take a look at in just a few moments' time. But how do you trade the S&P 500 given the context of what we've just been talking about?
Yeah, so I think it's honestly it's very tricky right now. I'll be very honest with you. As we are talking here now, we've got the jobs report coming out on Friday. Next week we have midterms. So from a seasonal perspective, U.S. equities, particularly the S&P, does tend to actually push higher after midterms. From a seasonal perspective. However, as we know, we don't have a very typical year this year. So I think, with the Fed having gone as hawkish again as they were a couple of days ago, the risk of a fourth quarter crash has increased. It's not my base case, but I was at about a 60% chance of rally into the end of the year, and I'm back right down to 50-50. What I want to see right now is I'd like to see how this market holds up not only after the jobs report, but after the elections. If we can hold that 3,500 area, so 3,500 on the S&P 500 cash, I think that's a pretty good obvious level to hold. But really, more importantly, let's see how the market maybe reverses. So even if let's say something happens that people don't like during the elections or whatever, and we dip into 3,300-ish on the S&P. If that reverses very sharply within a couple of days or so, I think it's right back on, and we could see the S&P rally, right back up to 4,200. So I think it's really going to be crucial to see how the market reacts and how things hold up. So for me, anything on the low end of about 3,300 to maybe 3,500, watch that for support. On the upside, if we can break back above 3,900, I think then we do actually have a decent chance of ultimately seeing that full sort of 20% rally in the fourth quarter, which could maybe get us back up to 4,200. So those are the support levels and what I'm looking at right now. But again, a lot of news.
This brings in a question about just where the longer term picture is, because as technical analysts, we often talk about capitulation. We talk about a market giving up, basically, just releasing it to let it go to wherever it wants to go. Is that drop you're talking about there down to the lows you were giving there a capitulation, or is that not yet seeing all the shorts out? Are we still expected at some point in Q1, maybe next year, to get a further lower low, which will strip out all of the negativity?
Yes, very much so. I think we're going to see lower lows next year. That has to be the base case. And the very simple reason I see that is because we've never seen an equity market, recessionary equity market drawdown like we're having right now, and before the Fed has stopped hiking rates. And the Fed, as we know, is still hiking rates. And so unless the only scenario in which the 33 to 3,500 area would hold as the final support in this bear market would be if something really awful happens over the next couple of months, something blows up, basically, whatever that is, could be in the private sector, could be in the public sector, and then the Fed, as a result of that, has immediately scratched to a halt and basically even cut rates, maybe. Extreme scenario, not my base case, but outside of that, I do think equities go lower again next year, the first quarter, maybe even the second quarter, because it's just never happened before where that equities have bottomed before rates. So 2,900 is about my number there, and that is the long-term support line. You can see basically on this chart, if we connect the lower dot of the 2009 lows and the COVID lows, we get to what is something between 3,000 and 2,900, depending on when we get there, of course.
It's interesting, isn't it? Picking apart what Jay Powell said on Wednesday in the press conference, and he was talking about the fact there that look, they're raising interest rates. They haven't yet had the full effect come through of anything like half as much, even as to what they've already put in the market in terms of tightening. It does take a while for the markets to catch up and the economy to catch up on where we are. So the fact we've got higher rates now, the full effect hasn't been felt. So let's wait for a while, I guess, until we see what the effect that is. You're right. We may end up seeing the Fed having to backpedal quite quickly. I promised we'd look at a couple of charts, these tech stocks that are now part of the S&P 500. And we're going to take a look at Amazon and also Meta. These two stocks have been beaten up in such a way. I mean, there may well be some people saying, well, look, it's deserved because they are a shadow of their former selves for whatever reason. The promises just isn't there for the sort of growth that they were looking at a year or so ago. How do you trade some of these US stocks that have been the whipping boys, if you like, of the market?
Yeah. Listen, I'll be quite frank. I think Amazon's starting to look more and more attractive. Now, Amazon and Meta are two different beasts for sure. But let me start with Meta just quickly. With Amazon quickly, apologies. So this is Meta. So stock's down about 45% year to date. A little bit less than half of that has taken place this quarter. So it's down a lot this quarter alone. It's down 12%, I think, even just over the past week, which is a quarter of what it's down for the year. So the rate of change, the acceleration has been increasing, which is good. That's what you want to see. Fundamentally, Amazon still has plenty of growth down the road. We think $58 billion of cash, strong balance sheet. So the question becomes at this point, in our view, is do we prefer to own something here, maybe for the remainder of the year, going into the first quarter of next year, that is a bit growthier, it's got a stellar balance sheet, and if you want to throw the charts in there, maybe it's coming into support. So long-term chart first, this is looking back all the way to 2002, and we can see essentially the stock, coming towards that blue line. It was nowhere near that blue line for a long time. By the way, the stock has basically done absolutely nothing now since 2018. So 4 years now. If we zoom in a bit closer, what we can see is I like to draw these support areas as areas and not so you draw support and resistance lines kind of like with a crayon, not with a pencil. And when I look at support here, I see anything between 100, which we clearly blew through, down to about 80. So we just the other day came into the lower end of that support cushion, and I think anything between here and 80 is really attractive. So I'm looking for any sort of meaningful bullish reversal days to maybe leg back into the stock. I see no reason why this can't go back up to 100 very, very quickly.
Yeah, as you say, this is a company with $58 billion worth of cash. But one must be mindful, of course, it is actually trading just below $1 trillion company again. It has previously been comfortably above the $1 trillion. So as you say, it is well off the highs. What about Meta Platforms? Meta has a very different sort of feel to it. Obviously, in terms of the company, is very different because it relies a lot on people's engagement at a personal level to this platform, which Mark Zuckerberg has been criticized for spending too much money. That's the fundamental side of it, which is another reason I think why it's been beaten up. But what about the technicals around Meta, which owns Facebook?
Yeah, no, look, I think at this point, when you look at it again, there's all the fundamental storyline behind it, which I think the press has covered extensively. At this point, there's really no support here. Like, this stock is just completely free fall. If we're going to draw some Fibonacci lines or something like that, that's about it. I think at this point, you have to look at momentum. Is it oversold from a momentum perspective? So to give you a little bit of perspective, this stock, I'm just going to go on a daily chart. This stock is currently trading about 50%. That's 50 or more, actually, below its 200-day moving average. Now, Meta is obviously no stranger to volatility, but that's a lot. if we go very near term, we look at something like an 8 and 21 day moving averages. So 8 and 21, the 21 day moving average is the yellow line on the screen. I know I'm moving a bit fast here, but the stock is currently trading 27% below its 21 day moving average. These are extraordinary moves. And yes, we've seen some of that before, but I think the odds here of the stock slowing down and ultimately giving us some sort of sharp mean reversion right now. I'm not calling the low for the bear market, but something that gets the stock back up 20, 30%, maybe to $110, $120 area. I mean, that is not outlandish to think that can happen pretty quickly once we start to see a little bit of calm in the market and maybe even just a year-end rally. So those are kind of my upside targets. What the downside where we looked at for would happen, I don't know, because we need to see it happen first. But I think it wouldn't take a lot considering the underperformance, the performance anxiety on the part of fund managers in the fourth quarter for something like this to unfold.
From a risk management view, what would you do about stop losses in this sort of situation? Would you keep them really tight? I mean, if you were to speculate on a quick zip back on the way up again, I would guess you'd want to make sure you weren't going to be facing too much of a loss if it didn't go the right way.
Yeah, no, that's great. Terrific point, Jeremy. So when we look at the volatility of something like this, I don't know what the average true range is right now of Meta. I have to quickly pull it up. But basically, when we talk about a stock at these levels, at this volatility, what we're looking at is essentially having to adjust position size. So position size essentially means that with this kind of volatility, this kind of average true range, we would have to essentially lower position size and widen stop levels, because otherwise you just get whipped out. At least that's my personal trading style. So lower position size and wider stops. The average true range right now is about 7 points. So basically the average daily range of the stock is about 7 points, or has been for the past 14 days. So 7 points is roughly, was that 8% or something like that right now, on a 14-day look back. I think whenever we have the bullish reversal, whatever that is, and it'll be very obvious on the chart once it happens, you set the stop 5% below there. Smaller position size, more wiggle room, because otherwise we just get stopped out.
Yeah. Okay, look, we'll have to leave it there, but as ever, Serge, thanks indeed for your time. It's a pleasure to be able to talk through some of your thoughts as we look out to the meat of November. And if you want to catch up more with Serge from steadytrader.com, you can do on his website. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.